Welcome back to Money Talks, the podcast that helps you make sense of the complex world of finance. Before we jump into today's topic, I want to share something a little more personal. Let me tell you, the struggle was very real when I first started studying for the CSC exam. I still remember staring at those endless pages of financial jargon, wondering how I'd ever make sense of it all. English isn't my first or second or third language, so I had to fight my way through every single concept. And yes, I even failed my first attempt. But that setback became my wake-up call. It pushed me to find a better way, not just for myself, but for everyone walking the same path. That's why I created this podcast and our website, mtalks.ca, to make your CSC journey clearer, simpler, and a lot more human. If you visit our freshly launched website, you can download our free, concise study guide, which walks you through every chapter and helps you focus on what really matters. And when you're ready to ace the exam, you'll find our full study package designed to get you fully prepared and confident to pass. Your support means everything. This isn't just about passing an exam. It's about breaking through barriers and creating the life you truly deserve. The finance world can feel intimidating, but together we can make it a place of opportunity and purpose. So let's learn, grow, and rise, one episode at a time. Speaking of opportunity, today we're diving deep into the world of other managed products. Think of it as exploring the less traveled paths of the investment landscape. And to guide us on this journey, we're thrilled to have financial professional Jonathan Cartier back with us. Welcome, Jonathan.
Thanks for having me, Rita. It's great to be here. This is an exciting topic because these products are designed to meet very specific investor needs that traditional funds might not cover.
So where do we start when we talk about these other products? What's first on the list?
Let's start with a product that looks a lot like a mutual fund, but wears a different hat: the segregated fund. The technical name for it is an individual variable insurance contract, and that name gives you a big clue. At its core, a segregated fund is actually an insurance product.
An insurance product. So I'm not buying shares or units in the traditional sense.
Exactly. When you invest, you're buying a contract from an insurance company. The company pools your money with other investors, just like a mutual fund, to buy a portfolio of stocks or bonds. But because it's a contract, you don't technically own the assets. The insurance company does. You are assigned what are called notional units to track your investment value. This structure is the key that unlocks its unique features.
And what are those unique features?
There are three big ones. The first is a maturity guarantee. Provincial law says that after a set term, usually 10 years, the insurer must guarantee that you'll get back at least 75% of your initial investment, regardless of what the market has done. Some companies even offer a 100% guarantee, though usually for a longer term or higher fee.
That sounds like a powerful safety net.
It is. Imagine you invested $100,000 right before a market downturn. 10 years later, the market value is only $65,000. With a 75% guarantee, you'd get back at least $75,000. It's a way to participate in the market's upside while putting a floor on your potential losses. The second feature is the death benefit. If the annuitant, the person whose life the contract is based on, passes away, the beneficiary is guaranteed to receive that minimum amount, often 75% or 100% of the investment. If the fund is worth more, they get the higher amount.
So it can protect your legacy for your loved ones. What's the third feature?
Creditor protection. Because the assets are owned by the insurance company, they are generally shielded from your creditors if you face bankruptcy. This can be a very valuable feature for business owners or professionals who might have a higher risk of personal liability. And a final bonus, because the payout goes directly to a named beneficiary, it bypasses your estate and avoids probate fees, which can save time and money.
Guarantees, death benefits, creditor protection. That all sounds great. Is there a catch?
The trade-off is cost. The management expense ratios, or MERs, for segregated funds are typically higher than for a comparable mutual fund. You're paying extra for that built-in insurance protection. So, the question for an investor is that peace of mind worth the higher fee?
That's a great reflective question. Let's shift gears to another product that has a unique structure, the closed-end fund. How does that work?
I want you to picture a cruise ship. The shipbuilder decides to build a ship with a fixed number of cabins, say 1,000. They sell all 1,000 tickets before the cruise begins. That's the initial public offering, or IPO. Once the ship sets sail, the company isn't selling any more tickets. If you decide you want to get on board, you have to find someone who already has a ticket and is willing to sell it to you.
So the number of shares or cabins is fixed.
Precisely. A closed-end fund raises a specific amount of capital once, and then those shares are listed and traded on a stock exchange, like the TSX. You buy and sell them just like a stock. This means its price isn't just based on the value of its investments, the NAV, but also on supply and demand in the market. A fund can trade at a premium, if it's really popular, or more commonly, at a discount to its actual value.
Why would it trade at a discount?
It could be due to poor performance, a change in management, or just general market sentiment. For a savvy investor, a fund trading at a deep discount can be a real opportunity. You're essentially buying a dollar's worth of assets for, say, 90 cents. A variation on this is the interval fund, which is a bit of a hybrid. It's a closed-end fund that offers to periodically buy back a percentage of its shares from investors, giving them an opportunity for liquidity.
That makes sense. Now, I often hear the term REIT, or Real Estate Investment Trust. Is that a type of closed-end fund?
It often has a similar structure, yes. A REIT is a company that owns and, in most cases, operates income-producing real estate. Think about a massive Canadian shopping mall like the Eaton Centre or a portfolio of office towers in downtown Calgary. As an individual, you could never afford to buy them, but you can buy units in a REIT that does.
So you become a sort of fractional landlord.
That's the perfect analogy. You're not dealing with tenants or fixing leaky faucets, but you are entitled to a share of the rental income. REITs are legally required to pay out most of their income to unit holders, which makes them very popular for investors seeking regular cash flow. They give you a way to invest in the real estate market without the massive capital outlay and headache of owning physical property.
Now we're moving on to something a bit different. Jonathan, let's talk about labor-sponsored venture capital corporations, or LSVCCs. That's a mouthful.
It is. You can think of these as investment funds with a specific mandate to provide capital for small and emerging Canadian companies. They're sponsored by labor organizations. The big draw here isn't just the investment itself, but the generous tax credits.
Tax credits always get people's attention.
Absolutely. Investors get a federal tax credit and, in some provinces, an additional provincial one. For example, if you invest $5,000, you could get a $750 federal tax credit and, depending on your province, another $750 provincially. That's $1,500 back in your pocket right away, effectively lowering your at-risk capital to just $3,500.
With a benefit like that, why doesn't everyone invest in them?
Two main reasons: risk and liquidity. These funds invest in small, unproven companies. The risk of failure is very high. Secondly, to keep those tax credits, you typically have to hold the investment for about 8 years. If you sell early, you have to pay the government back. So they're high-risk, long-term investments suited only for those with a high risk tolerance.
That's a very important distinction. Finally, let's talk about a term that feels very exclusive: private equity. What is it, and can the average person even invest in it?
Traditionally, private equity has been the domain of very wealthy individuals and institutional investors. It's exactly what it sounds like: taking an equity stake in a company that is not listed on a public stock exchange. Think of it as being one of the early investors in a promising startup long before it becomes a household name. The goal is to help that company grow and then exit the investment years later at a significant profit, perhaps by selling it to a larger company or taking it public through an IPO.
It sounds like the ultimate high-risk, high-reward scenario.
It is. The potential returns can be enormous, far exceeding the public markets. But you're dealing with illiquid investments. You can't just sell your shares tomorrow. You could be locked in for 5, 7, or even 10 years. However, the landscape is changing a bit. There are now listed private equity companies that trade on the stock exchange. These companies act as a holding firm, using their capital to invest in a portfolio of private businesses. Buying shares in a company like that is a way for a retail investor to get exposure to this asset class.
So, from the safety net of segregated funds to the high-stakes world of private equity, it's clear there's a whole universe of products out there. Jonathan, what is the one key takeaway our listeners should have when they think about these different options?
The key takeaway is that each of these products was created to solve a specific problem or meet a specific need. A segregated fund is for someone who values guarantees and estate planning. A REIT is for someone who wants real estate income without being a landlord. An LSVCC is for a high-risk investor who wants to support emerging Canadian companies and get a tax break. The question you should always ask is not, what's the best product, but what am I trying to achieve and which tool is best suited for that job?
A perfect summary. It's all about matching the tool to your personal financial goals. Jonathan Cartier, thank you so much for breaking down these complex topics and making them so much easier to understand.
My pleasure, Rita.
And thank you to our listeners for joining us on Money Talks. We hope this exploration has given you a clearer picture of the wider world of investing. Join us next time as we continue to make your money talk.